I think negative rates would be a mistake. What they do is they actually make it harder for you to achieve your goals. If your goal is to minimize borrowing costs for the U.S. Treasury, for example, you can get that with negative rates. You can also get that with quantitative easing, and I think that's what Jerome Powell is pointing out: is that just because the Fed's going about it a different way doesn't mean the result is different. And at the same time, if you keep rates positive, and perhaps you even keep the yield curve a little on the steeper side for all those who are thinking about yield curve control or somehow the Fed managing the rates at the long end. You want to make sure everything you're doing is supporting the ability of banks to make loans and to absorb losses. That's what you need when you're in a crisis, and that's what the Fed's going to be focused on.
And that's why bank stocks have been so weak. I mean, we showed that data at the beginning of the show. The median return of a bank stock through this year is negative 41%. That's the median. So obviously, some have done worse. Wells Fargo hitting new multi-year lows today. Is this the reason we are seeing such pressure on the financial stocks?
Well, I don't know what the reason is for seeing that pressure, but I do think that Powell is aware of the pressure, and I think when the Fed thinks about negative interest rates, it's the Fed. One of the things that they would concern themselves with is how it would affect banks. They want this to the extent possible, given the amount of support they're putting in, the amount of support the government's putting in. But the more the private sector can do on its own, the better. And so you don't want to put roadblocks up in front of the private sector. You want to make sure that they have the ability to manage things.
Let's talk more now about that, Drew, because jobs are at the forefront of everybody's mind. I mean, there's all this talk about, quote, reopening, and we're looking at all these signs of where things may be in 3 and 6 months. It's tough. You study 1918, 1957, 1968, maybe World War II. Is there any historical guidepost to what we're going through right now, which may indicate where we are going to end up?
Well, in my view, in MetLife's view, 1945 is a reasonable guidepost. It's not quite the same, but you do have some characteristics that are unique to now. But you also had unique characteristics every time, right? So the main thing is that in 1945, September 1945, demobilization caused basically there was a 6% decline in employment in a single month. So we've gone beyond that. But the important takeaway really is that it took about a year to kind of get everything sorted out in the labor market. That was without the capital stock being impaired. It was a transition in the economy from kind of the wartime economy to the consumer economy. Everyone wanted a job. Everyone was trying to kind of hire. It's that kind of making sure that you have the matching function working properly. So what you've seen in the response recently is trying to keep people attached to their current employer. But the problem, of course, is that for a lot of people, their current employer is not going to have the same level of demand that they had back in January. So you fast forward and you realize that there's going to be kind of a higher level of unemployment for a longer period of time, no matter what the policy response is, and no matter how hard firms try to make sure that they can kind of bring their people back. Simple fact of the matter is they're probably not going to need as many people when they do get back, at least for a period of time.
Yeah.